The upside surprise to payrolls, kind of expected, a market leaning towards it after the blowout ADP report. What did you make of the softer wages figure?
It's disappointing, and it tells you that the cyclical factors are being overwhelmed by structural issues. I think two messages here from this report, John. One is that this will make the Fed less likely to hike in March, so reducing the probability of a March hike. And secondly, it puts even more focus on structural measures to enhance wage growth in the economy.
Mohamed, you've described it as cyclically robust and structurally challenged, and we'll get to that point in just a moment, but I want to begin with the market action off the back of it. Taking March off the table, is that why we're seeing futures that much higher, up 84 on the Dow, positive 9 points on the S&P 500? Are we still playing that game?
We are to some extent. It's also having an impact on the dollar. But also remember that today we got signals that confirm that the Trump administration is going forward on its deregulation agenda. So that's having an impact as well.
Mohamed, how much of it is deregulation? How much of it will they have to make progress on the tax front?
So I think tax reform and infrastructure spending is what drives this economy forward in terms of growth, in terms of wages, and in terms of more inclusive expansion. I think that is absolutely key. Deregulation is more of a signaling issue, and I think, as Alan said earlier, one has to get the balance right in terms of deregulating on the one hand, and on the other hand, reducing soundness and safety.
Both tax reform and infrastructure spending are heavy lifts, as we would say in Washington. How worried are the markets about what this White House is doing and the way it approaches these problems right now? It's gotten distracted with immigration.
So for now, they're giving it the benefit of the doubt. They're waiting for people to be in place in the various official entities. We haven't yet had people in place in Treasury. There's still a lot to do in terms of getting the people in place. And as we've seen on foreign policy, that can have quite an impact. So the market is giving this administration the benefit of the doubt. It is waiting for announcement to go to detailed design, which, as you say, David, is tricky, and then to implementation.
All right, back to the intricacies of the jobs report here. That weak wage growth, Alan, to your expertise, are we making too big of a deal about it? I mean, year on year, it's still up 2.5%.
Well, it's up 2.5%. Inflation is, say, 1.8%. So we're seeing real wage growth. That's what you would expect with the unemployment rate below 5%. I had been hoping that we'd see it pop above 3%. Mm-hmm. Janet Yellen said a healthy labor market, you have nominal wage growth of 3 to 4%. I thought we were going to tip into that territory. But wages have been a challenge for the last 3 decades, and particularly wages in the middle and the bottom. And that continues to be a structural problem for the U.S.
And talking about Janet Yellen, we now see the probability of a rate hike in March, 26%. And we were over 30 as of yesterday. But manufacturing, though, you know that's something that President Trump is going to be hammering down today. Flat. What happened?
Well, I think it's a sign that all of the conversation about his comments on Carrier and Boeing and the auto companies really didn't have much impact. It suggests, I think, the real challenge in terms of rejuvenating manufacturing. I think it requires more innovation, investments in research and development, rather than closing off the U.S. to trade. But he's pursuing a different approach, and we'll see how it works.
Mohamed, a different approach, and certainly a different approach to the jobs numbers as they come out. There's a huge discrepancy between where, say, the Federal Reserve thinks the labour market is and where the White House thinks the labour market is. The fact of the matter is, though, Mohamed, if I told you that we were still adding payrolls at a clip of 200,000 and thereabouts every single month, that wages were still hovering around 2.5%, and that the underemployment rate had just ticked up to 9.4%, would you conclude that we were anywhere near full employment?
Well, if it was 9.4, no. But we are near full employment. The problem is the labor market is no longer functioning the way we had gotten used to from a cyclical perspective. So if I had told you, add one more data point, that we've created 15 million jobs, and at this stage we're still creating 227,000 per month, and yet wage growth is coming down, you would say, no, that doesn't make sense. But that is what's happening, and that's why I go back to the structural functioning of the labor market is changing, and we need to understand it a lot better.